Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 28th of September. Little doubt it's been a difficult week. COVID-19 has regained its status as centre stage, not only in terms of lockdowns, but in terms of its potential economic impact. Of course, in the US, it appears that any further fiscal stimulus may still be in deadlock, and that has weighed fairly heavily on markets. The situation, therefore, is that in the year to date, the Dow Jones is now down 6%, which is around 4% worse than last week. The S&P 500 has all but given up its gains in the year to date, up just 0.5% at the moment. The Nasdaq does remain the star of the show, although some of its gains have been shaved off. It's now up 19% in the year to date, while the FTSE 100 has also taken something of a hit and is now 23% down in the year to date. We can expect this volatility to continue as we move into next week. It will also, of course, next week mark the end of the third quarter, which means that in following weeks we can start to see some company results coming through, which generally speaking should be rather more positive than the previous quarter on the basis that lockdown restrictions had been eased. On the other hand, the outlook for the fourth quarter could be rather less optimistic. And being the first week, part week of a new month, we can also look forward to those important non-farm payroll figures in the US as well. On the corporate front, it's a fairly quiet week, probably a couple of stocks worth looking out for. The first one is FTSE 100 plumbing and heating merchant Ferguson, which reports its full year numbers. This is a company where we're expecting further details of its Wolsey UK business demerger, and also the fact that it's 85% of its sales come from the US means that obviously its fortunes are going to be closely allied to what's been happening there over the last few months. Shares are actually holding up fairly well, partly on the back of that demerger. They're up 7% in the year to date and actually up 80% since their March low. Another interesting company to look out for next week will be the online fashion retailer Boohoo. Now, here's a stock which has clearly had its problems. There were allegations in July of poor working conditions and indeed low pay at some of the factories which supply a lot of its goods. The shares actually dipped 45% on the back of that news. What's happened since, in fact this week, is that the shares have spiked. The company itself has come out with any number of actions which are going to improve the situation, including corporate governance, and that spike has basically meant that the shares now actually stand up 23% in the year to date, and that's despite that dip. However, if that negative press had any kind of impact on sales, that's something we'll find out about when we hear about those half-year numbers next week. Thank you for watching. Have a great week.